Hi, this is Tron Welch with Welch Financial Planning, and we are going to go through our economic update for the next 5-10 minutes and go through some slides that I think really illustrate where the economy is. You know, the big things that we're really focusing on is tariffs, the artificial intelligence spend that is going on, and then obviously inflation. And so those are the big components. I'd left out interest rates out of that list, but I really see inflation and interest rates being pretty tied closely together. So let's go ahead and hop into some of the material. All right, so for the first slide that we're going to go through here it's a little bit busy and a lot of different colors and all that, but the point is actually pretty simple. It's the components of GDP growth. And so that's, kind of the investment that's going on, consumption, obviously government spending is a big piece of the economy. But the point that I want to make here is if you look at the first quarter of 2025, you'll see net exports being kind of that purple color, negative amount, which means that we have a very large trade deficit. And then just one quarter later, second quarter of 2025, we've got a huge surplus. And so the point that I want to make here is the impact of tariffs. And what's happening in the first quarter of 2025, tariffs are getting ready to come in place. And so we're just importing from all over the place, trying to beat the tariffs. Foreign countries are moving inventory off of their shore and onto our shore, trying to beat the tariffs. And then 2025, basically, importing drastically declines because they've already got it here. And so the impact, or the thing that I really want to talk about is you and I on a day-to-day basis don't really see the impact of tariffs on a daily basis. We certainly see higher prices here and there, but businesses are running around actively managing, and there's obviously experiencing some disruptions due to the tariffs. And so a lot of activity is going on around that, even though you and I don't necessarily see it. From here, inflation is definitely getting sticky and definitely increasing. And you can kind of see, obviously this chart, the eye catcher is in, July of 2025, and inflation's gone down significantly since that. But you can kind of see, this is as of August of 2025. And it really has kind of been slightly creeping up over the last 5 to 6 months. And this is what the Federal Reserve is looking at when they're setting interest rates. Obviously, we just had a quarter-point reduction that just took place. But this is what's making them nervous, is that the inflation is taking place there. And that inflation, a lot of it is, some of it is obviously the workers that are leaving the country. But then the big piece is then the tariffs being put in place. And both of those are inflationary measures that are going on. So the other big component here is the artificial intelligence, and I'm working off the chart that you're looking at on the left-hand side of it. And CapEx stands for capital expenditures, and what that means is that companies that are setting aside money to build capital expenditures, whether that be into programming or equipment to build semiconductors or other physical capital structures there. And we're just talking about Alphabet, Amazon, Meta, Microsoft, and Oracle. And the term that they're using is hyperscalers. And it is absolutely phenomenal how much money these companies are pouring into artificial intelligence. So there's a gigantic arm race going on, and we'll see who's the winner here. But if you look at, just on this chart, 2026, they're talking about taking over 90% of their operating cash flow and investing that into R&D, or building out artificial intelligence, building the data centers, actually doing the program, and it's just absolutely phenomenal what type of commitment these companies are making. Next up is federal finances. It's really a theme for those that have watched me over time. I'm really uncomfortable with our federal finances. It just honestly just gets worse and worse. Really, I think back of Ronald Reagan largely running and winning based on trying to control the federal budget. And of course, he didn't, and no president has done that since then. The last president that had a deficit reduction time period was 2 years under Clinton. A lot of that had to do with lower government spending and still reasonable or moderate tax rates in there. So keep in mind that every dollar that the federal, I'm working off the left-hand side chart here, for every dollar that the federal government spends, 27% of that, 27 cents of that, is borrowed. And that to me just feels incredibly unsustainable. I can't run my household like that. You can't run your household like that. But the federal deficit is. We've seen, probably over the last, 10 to 15 years, we've seen that at 20%, kind of oscillating back and forth. But now we're up to 27%. Working on the right-hand side of this page, lower right-hand side, we see the federal net deficit. And we just see the growth rate forecast moving forward is just, it continues to be an upward trend on there. We have historically low taxes going on with historically high spending. And so out pops a deficit. Nobody seems particularly serious about addressing it. And so at some point, the music's going to stop. I don't know where that is. But at some point, investors aren't going to buy U.S. Treasury bonds. And when that happens, I have no idea what the outcome is, but it's not positive. So I would love to see somebody get serious about the deficit and not necessarily reducing the deficit, but just reducing the rate of growth, and even just going flat would be fantastic on that. Consumer confidence in the stock market. This is interesting to me in the sense of consumer confidence. Today, this is September of 2025, so new data. Consumers are not optimistic, and we certainly see that in our office. Talking with clients, we see that as we teach our financial planning courses up at CU. We're hearing a lot of angst and uncomfortableness. The consumers are just not confident of what's going on. And really, when that happens, there's typically a correlation to the stock market not doing well. And that has decoupled for sure. So the stock market absolutely continues to march on. 2025 has been a really nice year stock market-wise. And so it's just this, we're uncomfortable with what's happening in the economy, but then we're investing in the stock market. So we haven't seen that in the past. Usually those are kind of correlated, but that is decoupled at this point. So real quick on asset returns, I'm going to just really focus on the right-hand column, the year-to-date number. And we're seeing, a well-diversified portfolio should be up about 13%. This is as of September 30th. So today is the 9th. So just a couple days old on the data, so it's pretty reliable. So your portfolio should be up about 13%. More aggressive investors should be a little bit higher than that. More conservative investors should be lower than that. But we see the number one returning asset class year to date is EM, which stands for emerging markets. So traditionally that's been Brazil, Russia, India, and China, or the BRIC. Very little, or if any, investments going on in Russia. Excuse me. But it has been emerging markets. Two things that are driving that is the weakening dollar. As the dollar has declined against foreign currencies, that creates positive returns for international. And then emerging markets, it's not as much of economic growth that's causing that, but a little bit over just the stocks trading at such low multiples and being such an incredible value. That people just can't pass it up anymore. And so we are seeing money moving from our domestic market back overseas and largely into the emerging market sector there. So that's the big piece there. So with that, flipping over to interest rates and inflation, you can see where the 10-year Treasury is trading at about 4%, which is historically fairly low. It's kind of the highest mark since probably 2006, 2007. Over the last 10, 15 years, we're at the high mark for the 10-year Treasury. But if you expand that out, this chart goes back to 1958. It's still a markedly low interest rate environment on that. So interest rates are really important, obviously, and this is where the tug and pull really kind of comes in. So the federal board or Federal Reserve just lowered interest rates by a quarter. That's short-term interest rates, basically the rate that banks can borrow money. So it makes the money that banks borrow less expensive, which allows them to make loans at a little bit lower interest rate. But that's going to be on the short end of the lending cycle. So we're not really seeing mortgages haven't really declined out of that quarter point, and we don't really expect that. Car loans, maybe a little bit of help there. So we're not really seeing that quarter percent interest rate, coming into the marketplace very well. And some of that is, remember, somebody has to buy. When you make your car loan, that bank typically resells it, and they need someone who's going to buy it. And basically, if the interest rates go down, there's less people interested in buying it. So there's market forces. I don't think people understand how much interest rates are driven by market forces and less on what the Fed does. And so if nobody wants to buy a car loan at 4%, they can't offer 4% loans. They need to increase the interest rates to get it to go. And that is also true with mortgages. So there's a tremendous amount of debt level out there, and it looks like people are not interested in buying bonds at a lower interest rate at this point. They're holding out till the interest rates kind of come up before they purchase it. So we're not really optimistic that interest rates are going to decline over the next 3, 6, maybe even 9 months. We think they're going to hold steady for quite a while. Global earnings. I just think this chart is interesting, the right-hand side. And this is kind of, post-pandemic, where you see the dotted line. And the dotted line to the left of that is actual data, and to the right is kind of the consensus growth that's going on. And so the U.S. is in this chart, and we're doing really well. But India is leading the way on economic growth. And that looks like it's going to continue into the future. What to me is interesting is the China is represented as the lower line here. I know the colors between India and China are a little bit too close together, but China is the lower line there, and there just has not been as much economic growth in China, which is surprising because the China stock market is up 25 to 30% this year. And what's driving that is the stock market has been so lowly valued for such a long period of time that people are finally deciding to move some money into China just because of the stocks were on sale, honestly. And so it's not necessarily economic growth that's driving that, but a little bit more of the valuation that they've been getting. So we do see additional opportunity in China. We have looked at India and have placed a couple really small investments in India. But for the most part, India has been highly valued and is maybe a little bit overvalued today. So we're not going in very hard. And so that brings us to the economic update that I wanted to go through today. And then kind of in summary, the things that are really going to be driving the economy moving forward is really not so much interest rates, but I think tariffs are going to have a larger impact on the economy. Will probably be the number one lever as to whether our growth continues to kind of peter out a little bit or kind of launches forward. And I think that's going to be tariffs and maybe some trade deals that get signed. Trade deals that actually change the dynamics between us and another country, or trade deals that are really just kind of the same as they are today, just getting something in place so tariffs get removed. That to me is going to be the impact moving forward, followed by a little bit of interest rates, not so much of what the federal government does with the interest rates, but what you and I do with interest rates. Will we buy bonds at lower interest rates or not? And that will drive kind of economic growth moving forward. So hope this is helpful to you. If you have any questions or want to talk anything specific, just give a call. I'd be happy to spend some time with you. Have a great day, and we'll talk to you soon. Bye-bye.